Hello there, welcome back to the second part of my video on budgeting and forecasting. So in this particular video, as I promised in my previous video, we are going to consider the cash budget and then the master budget. Alright, so in my previous video, as we have already seen, we looked at the various functional budgets. We look at the sales budget, which we also identify to be the principal budget factor, and that particular budget, which is the sales budget, informed the production units that we want to produce. It also informed the cost of raw materials we want to use and also to purchase, and also it also informed the amount of labor hours we want to use and all that. So basically, we identified that the sales budget, which is the principal budget factor, limits or sets the limit for the preparation of all the other functional budgets. And so we are going to continue and prepare the last functional budget, which is the cash budget. Now, in this scenario, the scenario we are considering, the scenario is actually simplistic. So what we want to do is that after this video, I just want to set you running with how to prepare the cash budget. Then in my next video, I'm going to dedicate the entire video to the preparation of cash budget. But in that particular video, we are going to consider more complex realistic scenarios. All right, so in this video, we are going to continue the functional budget. So let's go to our scenario and see the information we have there that can help us to prepare our cash budget. So down the scenario, we have some information related to our budgeted cash flows. So it says the budgeted cash flows are as follows. So they've been divided into quarters. We have quarter 1, quarter 2, quarter 3, up to quarter 4. All right. Then we have receipts from customers given to us directly. In practice, the receipts from customers are not given directly, as you have seen here. It can be the calculation for the receipt from customers can be very complicated, but not much complicated for you to struggle with. Okay, but it can be a bit complicated, as in it's not be given to you directly, as you are seeing here. And then the same thing applies to payments to suppliers as well. That one too can be quite challenging. Alright, but in this scenario, we've been given our payment also directly. So we have payment for materials, payment for wages, and then payment for other costs and expenses. So that is actually what we have for our budgeted cash flows preparation. So quickly, let's come to here and then see how that is going to play out. So as I said, budgeting is usually done weekly, monthly, quarterly, or even yearly. Usually it is done monthly or quarterly. Okay, so our cash budget has been split into quarters, so we are going to follow the format given in the scenario. So we're going to have quarter 1, and then what I'll do is I'm going to use autofill. So I'll make sure my cursor tends to the plus here at the corner of this particular cell, and then I'll click and hold, and then I'm going to drag. Dragging it is going to autofill the other ones for me. So just like that. All right, so what we have here now, there are different approaches to presenting the cash budget. All right, and I'm going to introduce you to the two most popular ones. So what we do when we are preparing the cash budget is that we pick our receipts for the year, our budgeted receipt for the year, and then we are going to subtract our budgeted payments. Then the net amount is going to be added to our opening cash balance from the previous period. All right, so we are going to get our total receipts less total payments, and then whatever we get, which is the net amount, is going to be added to the opening balance of the previous period or from the previous period, and that will give us our closing cash balance for the budgeted period. So what we do is that one presentation form is actually really for you to so let me quickly bring, so we will have our, this is the format. Okay, I'm giving you the format. So we will have our receipts from customers, and we are talking about amounts that we are budgeting to receive from our customers. All right, so let me actually, okay, should be there. Then what we do is that we will less our payments. All right, we will less our payments. So we will less our payments like that. And from our scenario, the payments, we have payment for materials, payment for wages, and then other costs and expenses. So quickly I'll come here and then I'll have purchase of materials. All right, purchase of materials. We also have payment for wages, payment of wages, and then we also have payment for other costs. Payment for other costs and expenses. Okay, so here we have it. So what I'm going to do is I'm going to bring in the figures here directly, just like that. So I can have my equals and link the figures from the table here. So for quarter one, the receipt from customers is $1 million. So I'll bring my figure there. Let me expand this. Let me also expand this a little. All right, then I also come to my payments and link those up. So I will copy everything across. So I have that, and then I can copy this down, Control D, and then I can also copy it to the right, Control R, and then I also come here and copy my figures to the right, Control R. Okay, so we've got our figures set up there. So what do I do? Since the receipt from customers is only one item, there's no need for me to calculate the total. So quickly I can calculate the total for my payments. So quickly I can calculate the total for my payments. So I'll come here and then write my total payments. All right, so what do I have there? I have alt equals to add everything for me, so I can have that, and then I can copy it across using Control R. Then we are going to, now this is where the presentation comes in. This is formal. This is how it is always. We always have our receipts from customers, and then we less our payments to suppliers or payment for other things. Okay, so we'll have our total receipts, and then we'll have our total payments. So let me actually bold this, Control B to bold it to differentiate that, or let me also insert a border here so that it becomes nice. Okay, so the presentation difference now comes in. So what we have here is that after calculating our total payments, we are going to calculate our receipts less payments. So I'll have my receipts less payments, and then what I have here is that I'm going to pick my receipts and then I'm going to subtract my payments. Okay, so that is what we have there. So that's the receipt less payments. All right, so what we have here is that this is where the presentation difference comes in. You can decide to bring your opening balance here. Okay, so you have opening balance from the previous budget period. So we have our opening balance, and then from our scenario, let's go to our scenario and see what we have there. So the opening cash balance can be found on the face of the balance sheet. All right, so let's go to the balance sheet and see what we have there. So this is our figures from the previous period. All right, so remember the balance sheet is for the previous period. So we are coming here, and then we have our cash balance. That is the balance from the previous period. So we will come here, and this is the first presentation I'm showing you. So we'll come here, and then I'll write my 34,000 here. All right, so what we'll do is that because I've written this here, my total receipts have changed. So I'm going to add the opening balance to the total receipts, and then that will give me my total receipt for the period. So let me insert another line there. Okay, so what I'll do is that I'm going to add those two together. So using control alt equals. I'm going to add those two together. I'll bold it. Let me insert a border here, and then I'm going to so I'm going to insert a border for all of them there, like that, and then I can copy the formula across. Now you realize that we don't have this figure, the opening figure, we don't have for quarter 2, quarter 3, and quarter 4. What we are going to do is that it's going to follow a corkscrew method. So what we mean by that is that the closing balance on our cash budget is going to be the opening balance of quarter 2. So the closing balance for quarter 1 becomes the opening balance for quarter 2. The closing for quarter 2 becomes the opening for quarter 3. So it follows a corkscrew movement like that. And listen. So from here we move down, then from down we move to the top, from top we move down, from down we move to the top, like that. So that's how it will be flowing. So we have our total receipts. So quickly I'll come here and then adjust my this figure here. Now because I have put my opening balance here, this balance will not be receipt less payment, but rather is going to be our closing cash balance. Okay, so it becomes our closing cash balance, and so this particular formula here changes to the total receipt plus the opening balance, and then we're going to subtract the total payments here, and then we'll have 114. Now this particular 114 will become the opening balance for quarter 2. So I hope you get it. So I'll come here, and then I'm going to link this one together, and then we'll have that particular amount there. Then this, I can now copy this formula across using Control R. So we have that. Then this particular amount also becomes so I can actually also copy this one across using Control R. So that is what we got there. All right, that's what we have there. So the last balance here becomes the closing cash balance for the period. The very last balance here becomes the closing cash balance for the period, and this is what is going to appear on our statement of financial position, or the balance sheet. So as we saw from this particular balance sheet here, we use the amount, which is 34,000, as the opening balance for the quarter 1. The same thing applies here, so that when you use this, it becomes the opening balance for the next quarter, all right, the next year's quarter 1. Okay, so it follows like that. So this is the first form of presentation. Now the second form, what I'm going to do is that I'm going to copy the whole of this up to my total payments, and then I'm going to copy that, and then I can paste it down here. Okay, so This is for illustrative purposes, so I'm going to undo this and paste it special, and I'm going to paste the values there. Okay, so I'm going to paste just the values. Okay, so we've got that there, and then I can delete this one off and also reduce the number of spaces right there. So what we have here is that we have our receipt from customers. So here we are going to have our receipts. This is the second presentation. All right, so we have our receipts less payment, and that is going to be equal to the receipts here less our payments. So I'll have 80,000 there, and then I can copy the formula across. Let me differentiate that. This is for illustrative purposes, though I don't want to make it I don't want to waste time on it designing anything. All right, now what we do is that we are going to now have our opening balance here, and then we'll have closing balance at the end. I am sure you are getting where I'm trying to get to. All right, okay, so we have our closing balance right here. So what we have here is that the opening balance is, as we know, 34,000. That is going to be added to the receipt less payments to get our closing balance. So let me bold that, and then this will be equal to the receipt less payment added to my opening balance, and that gives me 114. Then the closing balance here, the closing balance for quarter one becomes the opening balance for quarter two. So I'll come here and then I'll link that up, and then I'm going to add this. I can now copy this across just like that, and then now I can copy these two across, Control R. So we have our figures there nicely done. So these are the two presentation methods of the cash budget. All right, these are the two presentation methods. Now quickly let's go to the master budget. As I said, I'm going to come back to the cash budget, and we're going to look at a more complex situation, a more realistic situation where you have to calculate for the receipts from customers and then also calculate for your payment to suppliers. All right, so we are going to get there, and then we are going to get right into it. So let's go to our master budget. Now the master budget is or it comprises our income statement, which is budgeted. So we have our budgeted income statement, and then we also have our budgeted balance sheet. All right, remember the balance sheet in our scenario is that of the previous period. So we are now going to prepare the balance sheet for the budget period. So that is our master budget. The master budget comprises of the budgeted income statement and the budgeted balance sheet. So let's go and see how we are going to do that. Okay, so what we have here is we have the budgeted income statement for the year. Okay, so we don't have any particular year for our scenario, so I'll come here and then I'm going to format this as usual. So let me center that. So let me center that, put it in the middle, and then also add the font color or the fill color, and let me also change the font color to white, and then also increase the font size a little bit. All right, so we have that set up there, and then we are going to have, if you, in case you are not very familiar with how to prepare financial statements, kindly refer to my video on the preparation of financial statements. Okay, so I've detailed how to prepare financial statements in Excel in that particular video, so you can check that out if you haven't or you have little to no idea about how to prepare the financial statement. Now, this is the financial statement of a manufacturing firm, and so it's going to be a bit different from the normal income statement of trading organizations. All right, this is a manufacturing concern. They manufacture the products and then they sell, so it's going to be a bit different, but the procedure is the same, just that we are going to encounter different items in income statement line items. Okay, so we are going to get right into it and then you understand it. So we have here, I'm going to have my $2 signs here. So let me put it here like that, and then I can actually increase the size of this. Okay, so we know that we always start with revenue or sales. Others call it sales, you can call it revenue. So our revenue is gotten from the sales budget. All right, so this is our total revenue, 429600. so I should have linked that up. So quickly I'll come to the last page here, and then I'm going to link the value of my revenue from my sales budget, which is 429600. So I'll hit enter there. So that is our revenue. Then, because this is a manufacturing firm, we are producing, so there is a cost of production. So what we do is that we are going to less costs of production. If it were a trading organization, we would have seen less cost of sales. All right, I'm sure you are familiar with less cost of sales, but this one is production, so we are going to have our cost of production. That is the only difference. Okay, the procedure is the same, the terminology is the only difference here. So with our cost of production, we had an opening inventory. Sorry. So what is our opening inventory? It's going to come from the previous year's balance sheet, because the previous year's closing inventory becomes, sorry, so the scenario is actually here. The previous year's closing inventory becomes the closing inventory, the opening inventory for the current period. So what do we have here? We are going to have this particular inventory here. So we have our inventories of raw materials. Okay, now we are talking about production. And we use raw materials in production. We don't use our finished goods in production. That is why we are using the raw materials finished inventories. Our raw material inventories. All right, so that is 189,200 there. So quickly I'll come here to the first column, and then I'm going to link my opening inventory of raw materials. So I'm coming, we'll link that. So to make this explainable or self-explanatory, let me have opening inventory of raw materials. All right, then what we have, we are going to add purchases. Also of raw materials. So we have our purchases of raw materials, and where are we going to get that? We are going to get it from our materials purchased budget, so annual budgeted materials purchases. So that is the figure we are going to pick there. So what do we have? We are going to pick this value and add that of material X to it to get our total material purchases budget there. Okay, so that is what we've got. Okay, so we can add this up using alt equals to add that up, and and then let me insert my border here. Okay, so what we have here, after adding our purchases, we are going to less the closing inventory of raw materials. So what do we have here? That can also be found within the materials purchases budget. So let's go to the material purchases budget. So when you come here, you will see the closing inventory, the units in units, and then also the price per unit. All right, so what do we have to do? We are going to pick the closing inventory for material X. So we are going to pick the budgeted closing inventory for material X and multiply it by its price per unit, and then we add that to the budgeted closing inventory of material Y, and then we are going to multiply that by the price per unit. So let's see how you are going to do that. So I'm going to pick that, and then I'm going to multiply it by the price per unit, and then I'm going to add it to this particular value multiplied by the price per unit as well. So we have a very long formula here. It's not long, it's just the name of the table that has been added to it. Okay, so I'll hit enter, and then you have 106.40 there, and then quickly let me format that as an accounting figure there. So that is what we have there. So getting that, we are going to have our costs. I'll subtract the closing inventory from the total inventory of raw materials to get my cost of raw materials consumed. So I'll have my cost of raw materials consumed. Now this total figure here is what we call the cost of raw materials available for use, okay, or for consumption. So when we subtract what has been left at the end of the period, then we will get the cost of raw materials consumed for the period. So I'll have this, and then I'm going to subtract the closing inventory of raw materials to get my cost of raw materials consumed. Then after getting that, I can add my direct labor costs, and that can be found from our direct labor cost budget. Okay, and that is also going to be this plus this. So we have $151,290 there. So getting that, I can also now add my production overheads. So I'll come here, and then I'm going to link my production overheads there. Remember, all of these form part of our cost of production. So everything that makes up the cost of production is what we are calculating. So the cost, we started with the cost of raw materials. So quickly, let me add this first. So here we have our 804,606 there. So let me link that up. So what we are doing here basically is that we are looking at our cost of production. Now, what are the elements of the cost of production? We have our raw materials costs, which is cost of raw materials we have used or consumed, and then we are going to add the direct labor costs, and then we are going to add our production overheads as well, and that is going to give us the total cost of production, or the total cost of manufacturing or production, whatever term you want to use for it, can get it right there. So I'll come here, and then let me do alt equals alt equals, and then I'm going to reduce so it's going to start from the cost of raw materials consumed plus our direct labor cost plus the production overheads, and that's going to give me my total cost of production as 4191474. So we have $4,191,474 right there as our cost of production. Then, because you sell, and this particular company produces and sell, we are now going to look at the finished goods components. These are for our raw materials and then production. Now after production we sell, so let's look at the selling components. So what do we have here? We are going to add the opening inventory of the finished goods. So we have our finished goods. So what do we have here? We have the opening inventory of finished goods, and that can also be found from our previous year's balance sheets. So let's go to the balance sheets. This is finished goods inventories, so that is 99,076 there. We are going to add that. So quickly, let me do my alt equals to add these two figures together, and then let me insert my border here. Then we are going to less our closing inventory of finished goods. All right, now this is another complication. When it comes to the calculation of the cost of the closing inventory, we need to be careful because we are considering the budgeted period. When it comes to the opening inventory, we are just picking the previous year's figure, but when it comes to the closing inventory, we are picking that of the budgeted figure. Okay, so we are going to make use of our current year's budgeted figures for calculating our closing inventories, whether it's of that of raw materials or for those of our finished goods. All right, so we'll go to the so what we have here is that to actually calculate the closing inventory of our finished goods, we need to do a bit of working here, just a bit. So quickly I can come here and then I can do a bit of workings here to determine the amount that I'm going to use to multiply with the closing inventory of finished goods units to be able to get my dollar amount. So what we've got here is that we are going to calculate the per unit for each of our products. So I'll have my product UG and then PG here. Now follow me carefully. So what I'll do is that for UG, so actually let me cut this and then paste it here. Okay, so for UG I'm going to have units and then I'll have the dollar amount there. Then I can do same for this, so I can copy this and do the same for PG as well. So what we have here is I'm going to have material X, okay, then I'll have my material Y, then I'll have my labor costs, and then finally I'll have my production overheads. Now what we are trying to do is that we are going to pick the units, the materials per unit, and then we are going to value them at their cost per unit. We will pick the material X and Y both. We are going to pick our labor cost per hour and multiply it by the number of hours needed to produce this particular unit or 1 unit of UG and PG as well. So I'm going to put that into practice and then you're going to understand it. So what we have here is that how many units of material X do we need to produce 1 unit of UG? We can find that within the scenario. So from here we know that we need 10 units of material X to produce 1 unit of UG. This is what we have here. So I'll come here and then I'm going to link that up. So we'll have 10. This one, there's no need for me to do that. So we'll have 10 here. Then for material Y is 5. For our labor cost or for our labor hours is going to be 10 as well. And then when it comes to the production overheads, the production overheads are in departments. So we have department 1, which is responsible for producing UG, and then department 2, which is responsible for producing PG. So when we know that the production overheads are absorbed on the basis of our labor hours. So what do we have here? How many labor hours do we have for UG? It is 10, as we have seen here. And then for PG is going to be 15. Okay, so what we have here is that we are going to have the same thing for the PG. Now let's go to the scenario and check that out. So for my PG is going to be 8, 9 and then 15. So I'll come here and then I'll write 8, 9 and then 15, then 15 also for this. So this is what we are having here. Okay, what we are trying to do is that we want to calculate the per unit amount of our UG. Okay, the per unit of amount of our UG and then the per unit amount of our PG, so that we can multiply that by the closing inventories left in store. Okay, we can multiply it by the units of inventory left in store or finished goods, so that we can calculate the closing inventory amount we want to use here in our budgeted income statement. That is what we are doing here. So what do we have? We will have so I think I have to insert another column there. So we have a dollar amount right there. Okay, then I'll also come here and insert another one, so that I will have my dollar amount right there. Okay, so this is what we've got here. So what is the material X per unit? Let's go to the scenario. These are the units, remember, and these are the dollar amounts. So material X is being sold at 7.20 per unit. Material Y is being sold at $16, and then our labor cost per hour is $12. So we have 7.2, 16 and then 12. So quickly let's come here and insert those figures there. So we have 7.2, we have 16, and then also we have 12. For the production overheads, we need to calculate that. So just wait, we are going to calculate that within the production overheads budget. It's not difficult. It's not difficult at all. So we'll come here and then we'll insert the same thing for and then we are going to input the same values there. So we have 7.20, we will have our 16 here, and then we are going to have our 12 here as well. Now when it comes to the per unit amount of our production overheads, we can go to the production overheads budget and then we can do that. Now the production overheads. These are the amounts of the production overheads, and we calculated these amounts using our labor hours. So as you can see from the formula here, we used our labor hour and then total number of labor hours that we are supposed to use. Okay, and that is 1020. So selecting that gives me the 102,000 here. I can come here also. Sorry. So let me undo that using Control Z. So quickly, let me check this one as well and see the number of hours we used. So I can come here and then I'll check the number of hours there, and that is 24 and 75. So quickly, what I'll do is that I will have my number of hours here. This is 102,000, and then this is 24 and 75. So our production overheads, so I'll come here and then I'll write production overhead per hour. So first of all, we need to calculate the total budgeted overhead. So what do we have? We are going to add the controllable overheads to the non-controllable overheads, and that gives me my total budgeted overheads. So I can do that, Control R. Okay, now we are going to divide the total by the number of hours. So I'll come here and then I'll have my total budgeted production overheads divided by the number of hours, and that gives me 6.0, and then I can copy the formula across, and that gives me 8.0. So when I come here, I'm going to have 6 and then I'm going to have 8. Okay, remember the departments are referring to the products. UG is produced within department 1, and then PG is produced within department 2. So that is what we've got there. And let me put this one too at the middle there. Okay, so now that we have this, I can quickly multiply these two figures so that I know that when I produce UG, when I produce 1 unit of UG, I'll use this amount, okay, of material per UG, so that when I add everything together, it is going to give me the total cost of producing 1 UG and then PG respectively. So I can come here and then copy the formula across using Control D, and then I can come here and then do Alt equals to add everything together, and that gives me 332. So that's the cost of producing 1 UG. Okay, that's the cost of producing 1 UG. I will come here and do the same thing. So I'll come here, multiply the 8 by the price per unit to get that, and copy the formula down, Control D, and I will have my Alt equals to add everything for me down there. So this is the cost of producing 1 PG. So from here, we know that it costs more to produce 1 PG than to produce 1 UG. Okay, so let's come to our budgeted income statement and calculate the closing inventory. So what do we have? We are going to the scenario, and then let's go to our total closing inventories there. So ending inventories required. Okay, ending inventory, this is referring to our finished product. This is referring to our finished product right here. So I'll have my ending product there, and then I'm going to multiply that by so I'm going to type this manually for now. So I'll have my 332 here, and then I'm going to add that to this, the closing inventory for PG, multiplied by 501.60. So I can actually calculate that. So coming here, I wanted to save time, so I can come here and then replace the 322 by the cell containing that particular figure there. So this, and then also I'll come here and then also delete this and replace it with this. Okay, and then I'll hit enter. Okay, so that is what we have for our closing inventory. I'm sure if you will watch this again, you will understand exactly what I just did. All right, so what I did was, in a nutshell, I just calculated the amount that it cost us to produce one product UG, and then the amount it cost us to produce one BG, and the amounts that we are using are the cost of buying material X, the cost of buying material Y, the labor cost involved in producing one unit of UG, and then the production overheads that will be incurred in producing the product. So those are the costs that we just multiplied by their units to get the cost of producing each of the units that we have calculated there. So that is as simple as that. So we will less our closing inventory, and then that gives us now our cost of sales. So we produced, we turned them into finished goods, and then we sold them. So now it becomes cost of sales and not cost of production. So our cost of sales will now be equal to the total amount available for sale less our closing inventory. So that becomes our cost of sales, and this amount can actually, let me actually cut it and put it here. Okay, so that subtracting it will give me my gross profit. So I have my gross profit there to be equal to the revenue minus the cost of sales here. So I'll just hit enter, and that gives me my gross profit. All right, then we have another expense, which is the selling and admin expenses. So quickly I'll subtract that. So I'll come here and have my selling and admin expenses, and that can be found within the budget, the respective budget. So quickly I'll come here. So let me insert a border here. So the selling and admin expenses can be found within the selling and admin budget. That is the total. So I can quickly come here and then link that to my balance there, and then subtracting that will give me my operating profit for the year. All right, so that becomes my operating profit for the year. So remember, it is what the budgeted. So let me actually put my budgeted there, budgeted operating profit for the year, and that becomes my gross profit less the selling and admin expenses. So that gives me my total profit for the year. Let me bold that, and then also insert my borders around it like that nicely. Okay, so this is what we've got for our budgeted income statement. So quickly let me copy that, and then we can move on to the budgeted balance sheet. So I can paste that here. Let me cut. So we'll have our budgeted balance sheet. Balance sheet as at budgeted balance sheet as at 31st December. Now I know why, perhaps you know why we call the income statement for the year whilst we call the balance sheet as at. This is one of the basic accounting knowledge you should have. The balance sheet is usually prepared at a particular point in time. So we are looking at the financial position of the business at a particular point in time. So this one, we are looking at it at the end, at the last day of the year. But when we talk about the income statement, we are talking about what happened from January to December, if that is the financial year of the firm. So we are considering all the transactions that has transpired throughout the entire year. That is for the income statement. But for the balance sheet, we are considering only items at the particular date we are preparing the financial statements. Okay, so that is just a bonus tip I'm giving you. All right, so with the balance sheet, we are still going to have two dollar signs here. So I have my dollar signs there, and then what I'll have is I'll have my first item here is going to be the non-current assets. All right, so the non-current assets, we have land. I'm actually going to leave the question within the video description for you to download. So please, you can actually go there. When you open the video, go to the description down below and download the question so that you can follow along. All right, so we have that. Let me put this. So we have land, we have buildings and equipment, and sorry, so we have buildings and equipment right there. Okay, so those are the two assets that we have. So let's just go to the scenario and confirm that. So actually, let me go there and then just link up my land figure. So let's go to the scenario and then we can pick our land figure there. So when you come here, we have our fixed asset. The fixed asset is also known as the non-current asset. All right, so let me actually pick that up, and then for my equipment, it has been depreciated. The buildings and equipment have been depreciated, so let's go and pick those figures there. So my buildings, the cost is 1,2 that, and then our depreciation is going to be the amount in our scenario, that is the opening balance of our depreciation, this particular amount. And then I'm going to, because this is negative, I'm going to put a minus here so that it becomes plus, because I'm going to add the new depreciation figure, which we can find within our selling and our production overhead. Okay, which we can find within our production overheads, and that is what we have here as depreciation. Remember, this is for the current year, so this is our current year's depreciation and budgeted amount. So I'll come here, pick this, and then also add the 80,000 for department 2 as well. So that is our total depreciation for the period. Now I can wrap this up around with the negative figure, another negative figure there, and then sorry, so let me put this in brackets and see what that will give us. Okay, so we have that particular figure there. So the difference now becomes the net book value of the building and equipment. So I have 857,000 right there. So I can add that, this particular figure, to my land figure to give us the total non-current assets for the period. So let me put that. Okay, let me also insert my down border here. Okay, now the next item within the balance sheet is our current assets. Now let's go to the scenario and see what we have there. So I'll come to my scenario here. My current assets, I have inventories. So we have inventories. Then so to change that, let me actually come here. This is supposed to be a colon, and then I'll have my finished goods as well as the raw materials. All right, I hope it changes here. Sure. So with the finished goods, I will have finished goods. And what is our finished goods figure? We are going to get that within the income statement. So our finished goods of closing inventory of finished goods. All right, that is going to be the closing inventory of finished goods. So we have 665,980 right here. So I'm going to link that. And then we also have our raw materials. Raw materials inventory, and that is also found within the income statement. So we have less closing inventory of raw materials as we have there. So I'll have that particular figure there as well. All right, then we'll have what we call debtors or receivables. So let's have our receivables here, or others call it debtors. So what do we have here? To calculate our receivables, we are going to pick the balance brought forward from our previous year's balance sheet, and then we are going to add our sales, because we do not know how much we sold on credit. What we're going to do is that we are going to pick the entire sales figure and add it, and then we are going to subtract the cash we received from our customers within the cash budget. I hope you get it. We don't know the debtors figure for the current period. We don't know our debtors figure for the current period. So what we do is that we are going to pick our total sales figure, and then we are going to subtract that. We are going to subtract the cash we received from our customers, total cash received from our customers. All right, so I'll come here like that, and then I'm going to subtract the total cash received. Now, to make this a lot simpler, we could have added a total column here, so that we'll have a total for all our balances here. But to make the video a lot simpler, we are just going to add the total for this. So what is our total of the receipts? I'll do alt equals to add everything there together, and that gives me 4305. So if you like, you can just come here and then do your totals here. Okay, so we have our total here. But when you come to the total for quarter 4, the total for the opening balance for the opening balance here is going to be only this amount. Okay, so the total here will be equal to the total amount for quarter 1 only, because that is the amount we brought from our previous figure. This figure is from what we've gotten from the quarter 3 here, so it cannot be the total for all of them. The total is the amount we brought from the previous year. Okay, so that is the only thing I want to add here. And then when you come here, the total should be equal to this amount here. So that is a take home assignment I'm giving you. Go and try it out to see if you get this particular amount at the end of the period. All right, so let's continue our master budget. So I'll come here, and then for my receivables, as I said, I'm going to pick the opening balance of our receivables or debtors figure. We are going to add our total we are going to add our total sales for the period, and then we are going to subtract the cash we have received from our customers, so that the difference will give us the the debtors or the receivables for the period. So I'll hit enter, and that gives me 280,000. Okay, then we'll have our cash, and then cash sorry so we have our cash and then cash equivalents. Remember, all of these are budgeted. All right, all of these are budgeted. That's why we are picking the information from the budgeted information, both in the scenario as well as within our budgets. All right, so what is our cash and cash equivalents? That is going to be the balance of our cash, which is this amount here. So I'll hit enter right there. Then with this, I can calculate my total current assets. So equals, let me bold that and also insert my border here. Then after getting our current assets, we bold this one as well. After getting our current assets, what we do is that we are going to have our current liabilities. For our current liabilities, we will have our payables. So the payables is also going to be calculated in a similar way as the receivables. So what do we have there? We are going to have the opening balance of our payables within the scenario. Within the scenario, so we'll have equals the payables figure given within the scenario 248 days, and then what we're going to do is that we're going to add the payments we have made. Okay, the purchases, sorry. So we're going to add purchases of materials that we have made during the budget period. So we are going to our purchases, material purchases, and then we are going to add this total. This total is a total for the material X and Y. So I'm going to add this total, and then let's see if there is any purchases of indirect materials. So we made a purchases of indirect materials here. So we are going to add those two together. So I'm going to have this, and then also add this one together, and then we'll go to our cash budget and see if we have made any payments for the materials we have purchased. Now remember, the payments we are talking about, or the payables we are talking about, the purchases we have made on credit from our suppliers. Okay, any purchases we made from our suppliers on credit becomes a payable. Since we have not been given the value directly, we need to calculate it, and that is exactly what we are doing. All right, so what is our total purchases? So it means we have to calculate our total purchases. So let me just enter this value for now. So this cash budget is going to change, the reference is going to change. So let's go back to our cash budget and then actually add the total payments there. So alt equals, sorry, this is for the demo. So I'll actually come here and do alt equals to add my total purchases of materials. Let me control D that, and then this one also comes control R. Okay, let's quickly do that again. So quickly, I'm going to have my equals, and I'll have the opening balance of our creditors here, and then I'm going to add purchases of any materials you have made in the year. So what are our purchases? They are going to be equal to the total purchases here, which is 1785408, and then I'm going to add these are purchases of direct materials. Then you also come to our production overhead, and then you're also going to add those of our indirect material purchases. Okay, so I have my indirect material purchases there, and then I also add this one together, and then I'm going to subtract the payments we have made within the cash budget, and that is going to be equal to this particular amount here. That is our purchases of materials and payments we have made. All right, so I'll hit enter. Let me correct that and see. So still we have an error here. So we have our opening inventory. We've added the material usage and purchases. We have our production overhead budget. So this has been repeated twice. So let me quickly delete that. I don't know why it's appeared twice. So let's hit enter and see. So this gives us our payables for the period. Okay, so we are going to subtract these payables from our total current assets to get our net working capital. Okay, so that becomes this minus the payables. This amount is what we call the working capital. I'm going to add the working capital to my total non-current assets, and that will give me my net assets for the period. So this will be equal to the total non-current assets added to my net working capital, and that gives me that particular figure there, which I will call my total net assets. Alright, so let me borrow this, and then also wrap it around with my borders. Then we will have financed by. What are we financing these assets with? We are going to finance them from the scenario. Let's go and link it up from the scenario there. So we are representing it by 1,200 ordinary shares of $1 each. So I'll come here and then I'll put that there. And what is the amount? The amount is going to be this 1.2 here. Okay, then we also have our reserves. The reserves, let me undo that. So the reserves is going to be equal to the opening balance of our reserves. So it's going to be equal to the opening balance of our reserves, and then we are going to add our operating profit for the year, which is the budgeted operating profit for the year, which we actually have here. So I'm going to add this to that. Then I'll hit OK. So that when I add these two figures together, it's going to give me the balancing figure of 1,964,910. Voila, this is how we prepare the master budget. So what you've been hearing, master budget, this is what we are referring to. It's just comprising the income statement, which is the budgeted income statement, and then the budgeted balance sheet put together. That gives us the master budget. So in this video, we have covered the basic cash budget as well as the master budget, which is more comprehensive. All right, so this is how we end the section. In my next video, we are going to look at a more detailed cash budget scenario, and then we will see how we are going to make that budget, and then we are going to incorporate this knowledge into our financial modeling, and then we'll see how we are going to go about it. So stick to my channel. If this is your first time on my channel, please subscribe to the channel, and please like the video if you actually enjoyed the content, and consider sharing it with others so that they can also benefit. I'll see you in the next video.